Most traders think they are trading support and resistance, but in reality, they are just drawing random lines on a chart. And that is why they keep getting stopped out right before the market takes off. In this video, I'll show you why support and resistance fail so often, what they really are, and the method I use instead. One that has given me my most wins and the highest risk reward trades. And when we are done, I will show you exactly how to get into my private trading community where we share setups like this even before they play out. Because if you're relying on support and resistance line, you might be playing the market game instead of playing your own game. Now, this is a concept of support and resistance. Support is a price point or area where price finds it difficult to go below. When price falls to this region, it usually bounces back up. Resistance, on the other hand, is a price point or area where price finds it difficult to go above. When price rises to that region, it usually drops back down. When support is broken, it can become resistance. And when resistance is broken, it can become support. That is a basic concept of support and resistance. And most traders honestly understand this part. But here is where things start to break down and why most traders still lose using support and resistance. The problem is not the understanding of the idea. The problem is how it works in real market condition and why I personally don't trade the classic support and resistance. So first, it is subjective. No two traders draw it exactly the same way. The way you mark your line is almost certainly never the way I mark mine, and that means results will always be inconsistent. Some persons use the candle body, some persons even the wick sometimes matches, some persons use the whole region. So there is no clear rule when it comes to drawing support and resistance. Support and resistance are prime liquidity zones. Smart money knows that retail traders place their stop losses just above resistance and just below support. So they create these zones to eventually trigger your stop losses and take your money, which is the third reason. Support and resistance fail a lot more than people admit that they fail. These levels are not walls. They are just areas where the market has reacted from before. And if the market wants to move through them, it will, no matter how many times price bounced there in the past. Now, how many times has this happened to you? Price touches your level, stops you out, then reverse in that same exact direction you want it to move. It is not bad luck. That is how the market works. So instead of relying on classic support and resistance, I focus on something cleaner, less subjective, and more consistent. They are the psychological levels. Psychological levels are simply round numbers that the market naturally gravitate towards. Big players, the institutions, often take profit around this level, and that is why they can cause strong reversals. On the forex chart, there are these three last digits after the decimal, that is 000, 250, 500, and 750. For crypto like Bitcoin, it's the last three digits before the decimal. Now, here is the thing. Don't trade psychological level on their own. If you do, you will take a lot of losing trade. Instead, I trade them with confidence. That means three things: supply and demand zone at or near this level, break or structure leading into that level, and liquidity sweep. If price graph liquidity at this level before I'm reversing. When all these three things aligns, I'm looking at a setup with a much higher probability and often a much bigger risk reward than just trading basic support and resistance line. And let me show you how this works on a GBP JPY chart. So I want to try GBP JPY. So let's mark out the psychological level on this chart. So you mark it, of course you don't mark it all the way through, you mark it just close to where the price action is now. So I can start from here. So I've drawn a few psychological level. You can see them 6000, 250, 500, and all that. Now, let's look for our demand zone. So this is a demand zone. This demand zone lines up perfectly with this psychological level. And that is what I'm looking for. If we look at this side, you can see that this is a breakout structure. The market is clearly breaking structure at this level. And if you look at this particular one, this one above here, this is not a proper breakout structure. This is just a liquidity sweep. So I will not be considering this demand zone, even if we have a psychological level here. So this is what I'll be considering. If market comes down to this level, of course, this is already played out. If market comes down to this level, then I want to put my stop loss at the last swing and probably take it higher. This gives a very good risk reward picture. If it breaks below, then I'll have to consider this. Okay, this next level, there's no fair value gap here because it's already taken. So let's see how this plays out. We'll put our entry here and take stop loss to this low. Even this low is fine, and giving us a risk reward ratio of 3.9, almost 4. So if we see how this plays out, you can see that the market came down just down here. That's down to this psychological level, which is 250, that aligns with this demand zone and with a confirmed breakout structure here. And the market just went up to eventually hit a take profit. So this had to align demand zone with the psychological level. Now I need to clear something up because this is where a lot of traders get confused. Some people teach that support and resistance is the same thing as supply and demand. It is not the same thing. Support and resistance are just reaction points, areas where price bounce or drop in the past. So don't get it confused, because supply and demand zones are different. They are the origin of major moves where big orders from institutions or large players were placed. And that is why they are more precise and more reliable. If you treat them as the same thing, you miss what makes supply and demand powerful. This is the exact kind of setup we drop inside our private trading community. Just follow step 1 in the description of this video to join. Now, if you want to see exactly how I combine this strategy with structure, liquidity, and timing to get my best trade, watch this next video.